Welcome back. You're still with us on Smart Money, and today we're discussing about fixed income and why it's a great time to add fixed income to your portfolio given the rising interest rates. Rahul Goswami, the CIO of fixed income at ICICI Prudential Mutual Fund, is with us. Rahul, before the break, of course, we were discussing the pros and cons of investing in fixed income. But now tell us, which fixed income strategy do you find the most attractive for investors right now?
Yeah, thanks, Sonia. So we believe that low duration funds and the low maturity funds, apart from that, that looks to be the best in case of rising interest rate scenario. And one fact I may want to, mention is that the difference between one-year T-bill and the 10-year G-Sec, which was close to 300 basis points a year back, is now contracted to almost 60 basis points. So we believe that this spread is unsustainably low, spread of 50 to 60 basis points, and at some point of time, this spread will again widen. And we believe that high interest rates or these interest rates at current levels are likely to persist and may inch up higher only. So we believe that the risk is on the higher maturity, higher duration segment. But at the same time, we believe that up to in the low duration and for funds like, say, ICICI Prudential Low Duration, ICICI Prudential Floating Rate Fund, like, say, ICICI Prudential Short Term Plan, or the All Seasons Bond Fund are great funds to invest in for having a safe and experience which will be in line with the investors' expectation and requirements on their pure savings investment requirement funds.
Okay, so you said low duration funds, floating rate bond funds, perhaps some good options to invest into. For someone who is maybe, in a younger category, about 30 to 40, or even younger, maybe 20 to 30, and wants to take a bit of a fixed income exposure, what is the split? How much should one have in equities? How much should one have in fixed income? What's the best way to approach it, given the rising interest rate scenario?
Yeah, so I think they have different, investors have different risk appetites, and depending on their age and the investment requirement, they should consult their financial advisor. But broadly, we think that from that perspective, the balance funds are the best approach to look at, including like our ICICI Prudential Balance Advantage Fund. That's a great fund to have a more stable return over a period of time. And but frankly, with high interest rates which are prevailing right now and are further expected to rise, we believe that fixed income offers a much better opportunity than the other asset classes to invest and have the risk-adjusted return, which will be much better than the other asset classes.
Okay, so fixed income is a better asset class at this point. Got that. Which are the other strategies, Rahul, according to you, that you would recommend in addition to floating rate bond funds? I mean, you spoke about short duration, floating rate bond funds, but which are the other strategies that you would recommend?
On the fixed income, the other important strategy that we run pure on models is the All Seasons Bond Fund, which is being run purely on model basis and on factors which actually impact the interest rates with the lag. And so there we believe that for a long-term investor in fixed income exposure, I think they must be invested in ICICI Prudential All Seasons Bond Fund. Apart from that, we believe that the short-term plan, ICICI Prudential short-term plan, also offers a great opportunity because they are, apart from low duration and floating rate category, here the fund manager actually takes the call to maneuver the duration so that it tries to take the optimum benefit of the market movement and the inefficiencies in the market. So these two funds, apart from that, and apart from that, if the investor is genuinely looking at, has a stable investment horizon, then apart from these two funds is the credit risk fund, which basically caters to, which typically comes with relatively high credit risk, but not exactly it's a very high credit risk. It's a credit risk fund, which obviously comes with some risk element on the credit side, but it offers a great opportunity where the portfolio yields are close to 8.5% as we speak, and I think it offers great opportunity to divert your hard-earned savings money into more productive use and achieve your financial goals in medium term.
Okay, since we're talking about fixed income strategies, right? We do have a segment on our show, Rahul, every week where we give one financial health tip of the week. And since today's show is on investing in debt funds and fixed income, I thought let's talk about the health tip of the week, which is also about fixed income investing. So in case you've never invested in fixed income, here are 5 reasons why investing in a debt fund as part of your overall investment portfolio is a great strategy. 1, there's a low-cost structure. 2, you have stable returns, relatively stable returns. 3, high amount of liquidity. 4, there's reasonable safety. And 5, there's diversification away from equities. So the big question is, how do I pick a right debt fund? The first thing to do is check the average maturity of the fund's portfolio, as this has a bearing on your return. The lower the average maturity period, the lower is the fund's volatility and your returns. The second thing to do is make sure the fund's portfolio is reasonably liquid. A large percentage of corporate debt in the portfolio does not bode well in the short term, as it's relatively less liquid, corporate debt that is. The third thing to do is avoid schemes with small corpuses. That's because the funds do not disclose if there are any investors who own a substantial chunk of outstanding units. If there are such investors and they decide to redeem their holdings, then the fund could be forced to sell their holdings below the market rate. And fourth, the best tool to capture the interest rate sensitivity of a debt fund is modified duration. It tells you how much the price of a bond would move if interest rates move up or down by 1%. The higher the modified duration, the greater will be the impact of an interest rate change. So these are just certain, tools that you can use to pick the right debt fund. Rahul, come in on this. Anything that I missed out in terms of, what are the do's and don'ts while picking out debt funds?
So apart from that, you can also should be mindful of the more than maturity. I think the modified duration or the Macaulay duration, what the SEBI asks us, the mutual funds to disclose, and it is. It's available, say, on every 15-day basis. The whole portfolio and the portfolio details are available for all the mutual fund schemes for the debt funds every 15 days. And apart from that, I think more or less you have covered, but the credit quality of the portfolio also has to be kept in mind, and one should be aware of what they are investing into. There are more than adequate disclosures being done in line with the requirement of the regulator, where the regulator has done a great job in, making the portfolio disclosures much more clearer and, straight to the investors, so that there is less ambiguity to the investors and easy to understand. Apart from that, we firmly believe that mutual funds offer a great flexibility in terms of liquidity, diversification, and the risk control measures that one should exercise in investing, and that's what it is.
Okay, and those are the reasons to invest in debt funds. It's flashing for you on your screen, and the ways to pick a good debt fund. You spoke about credit quality, right? I just had a follow-up over there, Rahul. For an average layman investor, how does one check on the credit quality of the paper that the debt fund is investing in?
Yeah, so in Indian parlance, if you see the rating instruments have all the instruments have a rating, and they have been disclosed in the fact sheet, and the overall credit profile of the portfolio is also disclosed on the fact sheet, and the information is given on every 15-day basis. Apart from that, they can also consult any of the funds directly or their trusted investment advisors, but they should primarily understand that AAA offers the highest possible safety in the debt instruments. AA is high safety, and then unless the risk reward is commensurate, funds typically do not invest below AA unless risk reward is hugely favorable to them. But yeah, these are the broad parameters. Apart from that, funds invest majorly into the sovereign bonds, which include the securities issued by the Honorable Government of India as well as the various state governments. They are absolutely safe securities as far as the credit is concerned. Obviously, they do come with their own set of interest rate risk, and that the fund manager is expected to maneuver and keep the decision making in a way that suits the investor expectation and in line with the investment objective of the scheme.
Okay, Rahul, it was a masterclass that is much needed, right? A lot of basics is what we spoke about, but sometimes you need these basics to remember how to best maximize your portfolio. And thanks a lot for joining us on CNBC TV18. We've run out of time, but not out of topics. Keep writing to us. We love receiving feedback from you. Until we meet again, have a great weekend, and thanks a lot for watching.